During the past decade, many corporations across the globe have issued green bonds, which are identical to traditional corporate bonds, except that the proceeds from green bonds are dedicated to environmental and climate friendly corporate investments. As of last month, the cumulative green bond market exceeds $2.5 trillion. That's T for trillion. So this is obviously being a very big event in our capital markets, both in the US, in Europe, and in Asia. The question is, does the stock market care about green bonds? One important viewpoint is that the announcement of green bond issuance is a way to signal greater and better adherence by the corporation to environmental and climate friendly policies. The argument goes that employees, customers, suppliers, and investors prefer to work in, do business with, and invest in corporations that are environment and climate friendly. If the market values and is able to see the value of such a signal, the announcement of green bond issuance should elicit a positive stock market response for the company. We refer to the above joint hypothesis. Notice that this is the joint hypothesis, both that the company is going to adhere to more climate friendly projects and that the stock market views positively these climate friendly projects because investors, customers, suppliers view these climate friendly projects in a positive frame. So we refer to the joint hypothesis as the green stakeholder hypothesis. An alternative viewpoint is the greenwashing hypothesis, which posits that corporations will make announcements to signal to employees, customers, suppliers, and investors their intention, favoring better adherence to environmental and climate friendly policies, even though the corporate managers have no serious intention to follow through on the substance and spirit of their pro environment announcements. The literature on greenwashing is extensive and has grown exponentially in the past few years, so we have to take the greenwashing hypothesis seriously. For the greenwashing hypothesis, the stock market will respond non positively to green bond issuance announcement. One version of the greenwashing hypothesis would be that the stock market just ignores the green bond issuance announcement. That is, the response is statistically indistinguishable from zero. Another version of the greenwashing hypothesis holds that the stock market responds negatively to the green bond issuance announcement since it signals managerial awareness of some underlying corporate operational, financial, or regulatory problem that the company is not willing to address in a serious and substantive manner. Finally, stating the obvious, green bonds are also bonds. Hence, green bond announcements have implications about changes in capital structure of the company making the announcement. So, in this paper, we analyze the stock market response to a comprehensive international sample of over 1,500 corporate green bond announcements during January 2013 through January 2022. Consistent with the greenwashing hypothesis, we do not find any significant market response to these green bond announcements. We conduct a battery of tests to check the robustness of these results. We find that many companies in our sample have issued green bond multiple times, hence they made multiple green bond issuance announcements. The signaling impact is likely to be strongest for the first green bond issuance announcement. Subsequent announcements would have much less or no signal content. we find that the stock market response to the first green bond announcement is also not statistically significantly different from zero. This is further evidence in support of the greenwashing hypothesis. Our sample of green bond issuance announcements are from more than a dozen countries, including US, China, Japan, India, Sweden, France, UK, and Germany. It is plausible that the stock market response to green bond issuance announcements are different across these countries for the following reason. Different corporate norms of transparency related to financial and operating policies, differing strictness of environmental regulation enforcement, differing perspective of corporate stakeholders, the employees, customers, communities, investors towards environmental and climate issues. Hence, we split our sample by the country of domicile of the company making the green bond issuance announcement. The announcement day returns for green bonds in these countries are either statistically insignificant or marginally negative. Significantly, there is no evidence of positive announcement day returns for any country. We note that our main sample period is 2013 through 2022. Green bonds are a relatively new phenomena in the corporate debt landscape. It is possible that the market response to the announcements in the latter part of our sample period might be better informed regarding the corporate strategy related to green bonds, hence different than in the earlier period. We consider announcement returns for the following two sub-periods, 2013 through 2018 and 2019 through 2022. We do not find any significant market response to the green bond announcements in either sub-period. Overall, we conclude that the market does not respond to the announcement of green bonds. We then study the corporate response to green bond issuance. We first study the carbon emissions of green bond issuance announcing companies pre and post announcement. The green stakeholder hypothesis would suggest a decline in carbon emissions subsequent to the announcement of green bonds. On the other hand, the greenwashing hypothesis holds that there would be no change in carbon emissions subsequent to the announcement of green bonds. We document no change in carbon emissions subsequent to the announcement of green bonds. Next, we study the MSI ESG ratings of the green bond announcing firm subsequent to the green bond announcement. We find no change in the ESG performance of the announcing firm subsequent to the green bond announcement. Finally, we analyze the abnormal operating performance, return on assets, the ROA, after adjusting for industry, size, and own ROA historically of these companies of the green bond announcing firms. In the year of the green bond announcements, the abnormal ROA of the announcing firm is significantly negative. This is consistent with the argument that managers of these firms are using the green bond announcements as a cover for the poor business performance. Thank you.